Let me start with a question most Americans never ask themselves, but absolutely should. What if your entire financial future, your retirement, your freedom, your peace of mind, could be transformed by a strategy so simple that it feels almost too easy to believe? Because here's the uncomfortable truth I want you to sit with for just a moment. Most people work for 30, 40, even 50 years and still never build real wealth. Not because they're lazy, not because they're irresponsible, not because they don't make enough, but because they were taught that to become wealthy, they must do something complicated. Pick the perfect stocks, watch the market every day, predict recessions, read charts, listen to gurus, beat the S&P 500. And yet, listen closely to this, the people who do the best over the long run are usually the ones who do the least. They automate, they ignore the noise, they choose simplicity over sophistication, and they follow a principle so powerful that Charlie Munger considered it one of the most important ideas in all of investing. The first rule of compounding is to never interrupt it unnecessarily. Now, here's the twist. Most investors interrupt compounding constantly. Every time they switch stocks, every time they panic sell, every time they chase a hot tip, every time they try to outsmart the market, this video is going to show you a way out of that trap, because I want to give you something that 99% of Americans never receive. A wealth-building strategy that works even if you're busy, even if you don't want to research stocks, and even if you feel like you started late. Today, you're going to learn how to build a simple ETF portfolio that quietly grows in the background while you live your life. Raising your kids, building your career, drinking your morning coffee, doing absolutely nothing except letting the system work for you. And the crazy part? This approach doesn't just match most active investors. It outperforms them by a lot. Let me give you a pattern interrupt early. The average everyday investor underperforms the S&P 500 by 4% to 7% per year, not because they pick the wrong investments, but because they pick the wrong behaviors. They buy at the wrong time. They sell at the wrong time. They change strategies too often. They react emotionally to headlines. Today's video eliminates all of that. Imagine a future where you never pick a single stock. You never worry about timing the market. You never stress about which companies to buy. You never get stuck in analysis paralysis. And yet, your wealth grows consistently year after year. Imagine being able to look at your retirement accounts, your 401, your IRA, your brokerage, and instead of feeling overwhelmed, you feel calm, confident, in control. That's the transformation this video will give you. Because ETF investing isn't just easy. It's powerful. It's predictable. It's resilient. And it is perfect for busy Americans who want a framework they can run on autopilot. But here's where things get interesting. What if I told you that you don't need 20 ETFs? You don't need a complicated allocation. You don't need advanced financial knowledge. You don't even need a lot of money to start. What if I told you that 3 ETFs, just 3, can build more wealth than most people will ever accumulate in their lifetime? And what if I told you that these 3 ETFs don't require you to think, analyze, or research? They just require you to follow a repeatable process? Munger warned us decades ago. Take a simple idea and take it seriously. Well, the most profitable idea most Americans will ever encounter is compounding through low-cost ETFs, not stock picking, not day trading, not crypto hype, not whatever CNBC is yelling about this week. Just 3 simple ETFs. And today, not only will you understand how this works, but you'll walk away knowing exactly which ETFs to pick, how much to allocate, how to automate your contributions, how to rebalance, how to avoid the biggest mistakes, and how to set yourself up for a financially stress-free future. So here's my promise to you. If you stay with me until the end of this video, you will leave with the confidence to say, I finally understand how to invest properly, simply, and for life. This is the beginning of a new chapter in your financial story. A chapter where your money works harder than you do. A chapter where your investments grow without needing your constant attention. A chapter where you realize wealth isn't built by trying to be clever. It's built by being consistent. Now, let's talk about why this message matters more today than at any other time in recent memory. Before we dive into the mechanics of ETF investing, the how, we need to understand why this matters so much right now in 2025 for millions of Americans between the ages of 35 and 65. Because this isn't just another investing approach. This is a lifeline in a financial environment that's more confusing and more stressful than ever. Let's start with something simple. The world has changed, and retirement is no longer something you can wing. Your parents or your grandparents could rely on pensions. They worked 30 years, retired at 60, and collected guaranteed income for life. Today, pensions are practically extinct, and the burden of retirement planning has been dumped directly onto your shoulders. Your 401, your IRA, your brokerage account, your decisions, and that's the key problem. Most Americans were never taught how to make these decisions. They weren't taught how to invest. They weren't taught how to manage risk. They weren't taught how to think long term. They weren't taught how to separate market noise from financial truth. Instead, they were dropped into a system full of conflicting advice, endless products, constant news alerts, and people trying to sell them something. It's no wonder investing feels overwhelming. Now let's add another layer. Inflation. Prices have risen faster in the last few years than at any time in the last 4 decades. Groceries, gas, rent, insurance, taxes, everything costs more. And people feel it deeply. A dollar saved today feels weaker. A retirement account feels more vulnerable. The future feels less predictable, which is why simplicity isn't just nice, it's necessary. And this is exactly where Charlie Munger becomes so important. Many people know him as Warren Buffett's partner. But fewer people understand why Buffett valued him so much. Munger wasn't the man who found complicated opportunities. He was the man who helped Buffett stop making complicated mistakes. Think about that. Buffett himself once admitted that Munger taught him to avoid overthinking, overanalyzing, overcomplicating, and overvaluing his own intelligence. Munger's philosophy cut through the noise. He didn't spend time predicting recessions. He didn't obsess over charts. He didn't chase trends. He believed in clarity, and clarity is exactly what Americans need today. Munger said, if you can get really good at destroying your own wrong ideas, that is a great gift. And one of the most dangerous wrong ideas floating around right now is the belief that you must beat the market to become wealthy. You don't. In fact, trying to beat the market is the number one reason investors underperform. Dalbar, one of the most respected financial research firms in the U.S., has shown for years that the average investor dramatically underperforms the S&P 500, not because of fees or lack of access or lack of knowledge, but because of behavior. Investors sell when nervous, buy when excited, and change strategies too often. This isn't just theoretical. It's real, measurable, and devastating. Meanwhile, ETFs eliminate 90% of the emotional mistakes people make. And let's talk about time. If you're 35, 45, 55, or even 65, you are busy. You're raising kids. You're working full-time. You're paying taxes, dealing with bills, juggling responsibilities. Most people don't have 20 hours a week to research companies. They don't have the mental bandwidth to analyze financial statements. They don't have the capacity to watch markets every day. And honestly, they shouldn't have to. Because the truth is, most professionals can't beat the market consistently, even with teams, algorithms, and resources. So why should you try to beat Wall Street at its own game? This is why ETF investing matters more today than ever. The world is too noisy. The economy is too unpredictable. The markets are too fast. And your time is too valuable. ETF investing gives you clarity instead of confusion, consistency instead of stress, control instead of chaos. And most importantly, it gives you a system that works even when you're not paying attention. That's what today's video unlocks, because you don't need more information. You need better structure, a framework, a path you can follow for the next 10, 20, even 30 years. And that's exactly what the next section delivers. The foundational principles that make ETF investing the most powerful strategy for busy Americans who want real wealth without becoming part-time financial analysts. To understand why ETF investing is so powerful and why it outperforms most stock pickers, you need to understand the core foundation behind this entire strategy. If you grasp this one idea deeply, the rest of the video becomes effortless. It's the idea Charlie Munger spent his entire life preaching, studying, and refining. It is waiting, not intelligence, that builds wealth. Most investors don't fail because they're careless. They fail because they don't know how to wait. They don't let compounding grow uninterrupted. They feel the need to do something. They check their accounts daily. They react to headlines. They try to predict what happens next. But here's the truth that almost no one tells you. Wealth is not built by activity. Wealth is built by consistency. And ETF investing is the most consistent, stable, emotion-proof system regular Americans have ever had access to. Let's break down the foundation into three pillars. Every everyday investor faces the same three enemies. 1, high fees. Most mutual funds charge 1-2% annually. That sounds small, but it destroys your returns. ETFs like VTI, VOO, and BND charge 0.03% to 0.05%. Graphic suggestion, $100,000 over 30 years at 8% with 1.5% fee, $574,000. With ETF fees, $1,006,000. Difference, $432,000. Just by paying lower fees, you build an extra nearly $500,000. No extra work, no extra effort, just fewer hands in your pocket. 2, emotional decisions. People panic when the market drops. People chase hype when the market soars. People buy high, sell low, the opposite of success. ETFs block most of those mistakes. You're not betting on one company. You're betting on thousands of companies. Emotion gets weaker. Compounding gets stronger. 3, overconcentration. Your cousin tells you to buy Tesla. Your coworker swears on Nvidia. Your friend says Apple is easy money. Suddenly your entire future depends on 3 stocks. ETFs prevent this. They diversify you instantly across industries, sectors, and global markets. Here's something people overlook. When you buy an ETF, you own everything that wins, even if you never knew it existed. Example, if you bought VOO 10 years ago, you automatically benefited from Apple's rise, Amazon's explosive growth, Microsoft's dominance, Nvidia's meteoric climb, Google's expansion. Even if you didn't know these companies were going to dominate, even if you didn't know what an AI chip was, even if you didn't read a single earnings report, you win by default. Munger said it beautifully. The world is full of foolish gamblers, and they will not do as well as the patient investors. ETF investors don't need to gamble. They don't need to predict which company wins. They just need to own the whole market and let the winners reveal themselves. Now let's bring this to real numbers. Say you're 40 years old. You invest $600 per month into a broad market ETF returning 8% per year. Here is what that turns into. 10 years, $109,000. 20 years, $329,000. 25 years, $507,000. 30 years, $782,000. And if you increase your contribution to $800 a month, those numbers grow to 10 years, $146,000. 20 years, $439,000. 30 years, $1,043,000. This isn't luck. It's mathematics. It's compounding, doing exactly what it was designed to do, grow quietly, predictably, and exponentially. Most stock pickers never see this growth. Why? Because they interrupt compounding every time they switch stocks or time the market. Remember the Munger quote from earlier. The first rule of compounding is to never interrupt it unnecessarily. ETF investors don't interrupt it. They automate it. Let's make this more practical. Investor A, stock picker, buys and sells frequently, tries to beat the market, reacts to news. Average real return to 5%, fees 10-20x higher, emotional stress high. Investor B, ETF investor, buys monthly automatically, ignores the noise. Let's compounding work. Average return to 9%, fees near zero, emotional stress non-existent. Let both invest $500 per month from age 35 to 65. Final result, investor A, $399,000. Investor B, $813,000 or even $1, 1M. The ETF investor ends up with double or nearly triple the wealth simply by following the foundation we're discussing right now. Not by being smarter, not by researching more, not by predicting AI companies or tech cycles, just by using ETFs as the base of everything. Mini summary before moving on. Here's what you should take away from Core Concept has shown. ETF investing removes the biggest dangers. Fees, emotion, concentration. You profit from the rise of America automatically. Compounding becomes unstoppable when left alone. The simple approach beats the complicated one. Patience becomes your greatest wealth-building tool. This is the bedrock, the foundation, the engine that everything else in this video builds on. And now that you understand why ETFs are so powerful, it's time for the fun part. How do you actually build the portfolio? What ETFs do you buy? How much of each? How do you set it up? That's what Core Concept Hash 2 reveals next. Now that you understand the foundation behind ETF investing, the psychology, the compounding, the protection from emotional mistakes, it's time to take a big step forward. This part is where theory becomes real life, because it doesn't matter how powerful ETF investing is in books, studies, or YouTube videos. If you don't know how to turn it into a real portfolio that sits inside your 401 IRA or brokerage account, the knowledge does nothing for you. So in this section, I'll walk you through the exact ETFs to choose, why they matter, how much to put in each, how the portfolio adjusts based on your age, real dollar examples, and the mistakes people make when setting this up. This is the part where everything becomes practical, usable, and actionable. Let's dive in. Most investors make the mistake of thinking they need to own everything. 10 ETFs, 15 ETFs, international small caps, emerging markets, tech funds, value funds, dividend funds. It becomes a mess really fast. Charlie Munger had a powerful philosophy. The skill of good investing is maximizing simplicity. So we're going to use the simplest, strongest structure available. The 3 ETF total wealth portfolio. This structure gives you U.S. stocks, international stocks, bonds for stability, zero overlap, near zero fees, 100% diversification, a completely automated strategy. Let's break it down. This is the heart of your portfolio, your wealth builder, your long-term compounding machine. You choose one. VTI, total U.S. stock market, includes large, mid, and small companies. VUS and P500 focuses on the 500 largest, most stable U.S. companies. Which one should you pick? If you want broader diversification, choose VTI. If you want mega cap stability, choose VOO. The difference is small, and both work beautifully. This ETF will carry your retirement growth. Americans often forget that the U.S. is only 60% of global markets. International exposure protects you from U.S. specific downturns. sector bias, currency risk, political cycles, domestic slowdowns. You choose one. VXUS, Vanguard Total International, IXUS, iShares Total International. Both give you exposure to Europe, Asia, Australia, emerging markets, thousands of companies. This ETF adds stability, diversification, and resilience. This is the part that protects you during recessions and market drops. Stocks go up long term, but they can drop 20%, 30%, even 50% short term. Bonds soften the blow. You choose BND Vanguard Total Bond Market, AGG iShares Core Aggregate Bond. If you're 35, 45 years old, maybe 10, 20% bonds. If you're 45, 5520, 30%. If you're 55, 6530, 40%. The goal is emotional stability. The more bonds you hold, the easier it is to stay calm during volatility. Let's make this extremely clear. If you're 35, 45, 70% VTI, 15% VXUs, 15% BND. If you're 45, 55, 60% VTI, 20% VXES, 20% BND. If you're 55, 65, 50% VTI, 20% VXs, 30% BND. These are not rigid rules. They're proven, time-tested ranges designed for stability and growth. Let's take a 4 or 5-year-old investor. They invest $700 in VTI, $200 in VXUS, $100 in BND. Total $1,000 per month. If this portfolio returns a conservative 7%, here's what happens. In 10 years, $1,000. Mo, $173,000. In 20 years, $1,000. Mo, $520,000. In 25 years, $1,000. Mo, $788,000. In 30 years, $1,000. Mo, $1,132,000. All without touching a single stock. No timing, no analysis, just consistency. Buying too many ETFs, stick to 3. More does not equal better. Mistake #2, switching ETFs constantly. Pick your 3 and stay with them for 10, 20 years. Ignoring bonds. Bonds protect your emotions, and stable emotions protect your wealth. Mistake #4, forgetting to automate. Set automatic contributions, monthly, non-negotiable. Mistake #5, overreacting to the news. Your portfolio is a 10-30-year plan, not a 10-day plan. You now have the exact ETFs, the exact allocations, real dollar examples, a strategy you can automate, a structure you can run for decades. Now we move to something even more important. The advanced insights, the psychology, the secret sauce that separates average investors from wealthy ones. This is where Charlie Munger's deepest wisdom lives. Munger once said something that shocks people because it goes against everything investors think they should do. The big money is not in the buying or the selling, but in the waiting. Waiting is the hardest part of investing, but it's the part that creates the most wealth. ETF investors win because they don't jump around, don't switch strategies, don't fall for market noise, don't chase hype, don't panic during downturns. They simply wait. To understand the power of waiting, imagine this. If you invested $10,000 into the S&P 500 inches 1,990 and left it untouched, you'd have over $200,000 today. But if you missed just the 10 best days in the market because you were scared, emotional, or sitting in cash, you'd have only $95,000. More than half your returns disappear just because you weren't invested on a few key days. ETF investing protects you from being out of the market when you should be in it. You stay consistent. You stay invested. You stay growing. This insight alone puts you ahead of most investors. Charlie Munger had a mental model he used throughout his career. If something is too hard, we put it in the too hard pile and move on. Stock picking, too hard. Predicting recessions, too hard. Timing the market, way too hard. Beating professional hedge funds, almost impossible. But buying 3 ETFs every month, simple, repeatable, executable by anyone. The smartest people in the world win by being less complicated, not more. Let me give you a real Munger example. In the 1,970 seconds and 80 seconds, Munger and Buffett tried almost every kind of investing. Deep value, arbitrage, convertible bonds, market mispricing, special situations, high growth companies. But in the end, what made Berkshire explode wasn't complexity. It was owning a few great long-term assets, Coca-Cola, American Express, Apple, and a handful of others. These weren't secrets. These weren't niche. These weren't complicated. They were obvious. ETF investing works for the same reason. It's obvious and unstoppable. The markets grow because businesses grow. ETFs let you own them all. This is where the secret sauce really starts to show. Rebalancing is the process of selling a small piece of what has grown too large, buying a small piece of what has fallen behind. If your VTI allocation grows from 60%, 74%, you sell enough to bring it back to 60%. If B&D drops from 20%, 14%, you buy enough to bring it back up to 20%. Most investors avoid this because it feels weird. Why sell what's going up? Why buy what's going down? But that's exactly why rebalancing works. It uses behavior to your advantage by forcing you to sell high, buy low, maintain discipline, reduce emotional influence, lock in gains, keep risk under control. Rebalancing once every 6-12 months increases your long-term consistency and improves your returns without adding risk. Munger would call this the ability to behave rationally when others are behaving foolishly. That's behavioral alpha, the returns you earn simply by not acting like the crowd. Imagine 2 investors with the exact same 3 ETF portfolio. Investor A, no discipline, buys sporadically, stops investing during downturns, doesn't rebalance, panics every election cycle, tries something new every 2 years, emotional roller coaster. Investor B follows Munger's advanced insights, automates everything, rebalances annually, never sells out of fear, never chases hype, stays invested 100% of the time. Even with the same ETFs, the disciplined investor ends up with 30% to 70% more wealth over 20-30 years simply because they did not interrupt compounding. Here's what you should take away from core concept #3. Waiting builds more wealth than activity. Most strategies fail because they are too hard to execute. Simplicity is a superpower. Rebalancing makes you behave like a rational investor. Discipline creates more wealth than intelligence. Munger's wisdom turns a simple portfolio into a high-performance machine. Now that you understand the advanced insights, the next section turns this into something even more valuable. Exact action steps you can apply tomorrow morning. Now we have the foundation, the structure, and the advanced insights. This is where we transform everything into clear, step-by-step action, because information without action is just entertainment. And you're not here to be entertained, you're here to build wealth. So in this section, we will build a complete ETF plan that you can implement tomorrow morning, even if you've been overwhelmed with investing until now. You're going to walk away with the right account to use, the exact ETFs to buy, a clear allocation, automation steps, a rebalancing routine, and answers to the most common what-if fears. Let's turn your financial future into something predictable and stress-free. If you want to invest the Munger-approved way, you must start with the right container. Think of your investment account as the bucket that holds your wealth. Here are your options in order of priority. 8-1, 401. If your employer offers a match, This is a must. A 100% match on your contributions is the best return you will ever get. Example, if you contribute $300, your employer adds $300. You just doubled your money instantly. I2, Roth IRA, perfect for long-term ETF investing. You contribute after-tax dollars, and your gains grow tax-free forever. Next 3, traditional IRA, tax-deductible contributions, perfect for those in higher tax brackets. And 4, brokerage account. This is your flexible non-retirement investment account. 0 restrictions, 0 penalties, perfect for extra investing. Start with whichever applies to your situation and build upward. This is where simplicity shines. Choose one ETF from each category. X market, choose one. VTI, total U.S. market. EVAOS and P500. International, choose one. VXUS, total international. IXUS, global markets, XUS. Bonds, choose one. BND, U.S. bond market. AGG, aggregate bond index. That's it. Don't overthink it. Don't add 10 more ETFs. 3 is enough. Here is the simplest framework designed for stability. Ages 35, 45, 70% VTI, 15% VXES, 15% BND. Ages 45, 55, 60% VTI, 20% VXES, 20% BND. Ages 55, 65, 50% VTI, 20% VXs, 30% BND. This structure balances growth with protection as retirement gets closer. This is the heart of Munger-style investing. Automation removes emotion. It removes hesitation. It removes second guessing. You set $200 month, $500 month, $1,000 month, whatever your budget allows, and it buys your ETFs automatically every month, no excuses. Automation turns your financial plan into a machine. Real example, a 4 or 5-year-old investing $800 month at 7% annual return. 10 years, $137,000. 15 years, $243,000. 20 years, $398,000. 25 years, $623,000. Consistency beats strategy 99% of the time. Pick a month, January, your birthday, tax day, and make it your rebalancing day. Rebalancing means sell a little of what got too big, buy a little of what got too small. You're not timing the market. You're maintaining risk. You're locking in gains. You're behaving rationally. Example, your VTI went from 60%, 72%. Your BND went from 20%, 14%. You sell enough VTI to bring it back to 60%. You buy enough BND to raise it to 20%. 10 minutes per year. Massive long-term benefits. This might be the hardest part for most people. But listen carefully. Financial media profits from fear, urgency, and hype. Your portfolio profits from peace, patience, and consistency. Munger warned us, if you can't ignore the siren song of the market, you will suffer. Turn off the noise. Check your portfolio once a month or once a quarter. Nothing more. The less you look, the more you make. Here are the biggest fears investors have. What if the market crashes? Good. You're buying shares cheaper. What if I retire during a downturn? That's why we include bonds. What if I want to pick some individual stocks? Fine, limit it to 5-10% of your portfolio. What if ETFs feel too simple? Simple is precisely why they work. Here's what we just built. A complete ETF setup, an age-based allocation, a fully automated growth plan, a yearly maintenance routine, built-in risk protection, answers to major fears. This is everything you need to execute the strategy starting tomorrow morning. Now we step into something deeper, something emotional and transformative. why this strategy matters for your life, not just your money. We've spent this entire video breaking down the logic, the math, the ETFs, the allocations, the psychology, and the execution. But now we move into something deeper, something more human. Because investing isn't just about charts or returns or percentages. It's about the life you want, the future you're building, and the peace of mind you deserve. This section ties everything together. Because the real power of ETF investing isn't just financial growth, it's emotional stability, it's clarity, it's freedom from the noise, it's the ability to finally step off the hamster wheel of financial stress. Let's zoom out and look at the bigger picture. Most Americans today live with a low-level background anxiety about money. Am I saving enough? Will I have enough for retirement? What if something happens? What if the market crashes? What if I started too late? These questions create stress that lingers for years, sometimes decades. But here's the truth that nobody tells you. Uncertainty is the real enemy of wealth. Clarity is the real path to freedom. ETF investing gives you clarity in a world full of confusion. Instead of constantly worrying about picking the right stock, you simply buy the entire market. Instead of wondering if your timing is right, you invest every month automatically. Instead of panicking about downturns, you use bonds to protect your emotions. Instead of trying to predict the future, you allow the market's long-term upward trend to work for you. And slowly, the financial anxiety begins to dissolve. Charlie Munger once said, "Life is like a snowball. The important thing is finding wet snow and a long hill." Your ETFs are the wet snow. Your lifespan is the hill. And your consistency is the push that keeps the snowball rolling. This strategy shifts your mindset from speculator owner, chaser builder, worrier planner, reactor strategist. Instead of chasing hype every week, you follow a long-term plan. Instead of checking your portfolio 10 times a day, you check it once a month. Instead of trying to predict the unpredictable, you rely on a system that works. This mental shift alone will improve your happiness more than any return ever could. Let's bring this closer to home. When you invest simply, consistently, and intelligently, you become a financial role model for your kids. You eliminate needless arguments about money. You create a retirement that isn't filled with fear. You build a cushion that protects your future. You break the cycle of financial chaos many Americans grow up with. Imagine being the person in your family who finally says, "This stops with me. We're building a stable future from this point forward." ETF investing is the tool that makes that possible. One of the most surprising benefits of this strategy is how peaceful investing becomes. No more doom-scrolling recession headlines, panicking over election cycles, wondering what the Fed will do, jumping from stock to stock, gambling on hype, making decisions you regret weeks later. Instead, your mindset becomes, it doesn't matter what happens this week. My strategy is 20, 30 years long. I'm safe, I'm consistent, and I'm growing. The noise gets quieter. Your confidence gets stronger. Your wealth compounds. This emotional transformation is priceless. Let's zoom out even more. Money is not the goal. Money is the tool. The real goal is freedom, time, options, security, dignity, choice, independence. Most people fear retirement because they don't know if they'll have enough. But imagine the opposite. Imagine approaching retirement with confidence. Imagine knowing you built a system that worked quietly for decades. Imagine looking at your accounts and saying, I did this. I built something stable. I built something real. I built something that will take care of me. That is what ETF investing gives you. Not excitement, not thrills, not get rich quick, but real, durable, unshakable financial strength. Charlie Munger once said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." ETF investing is the embodiment of not stupid. It's the strategy designed for real humans with real lives, not for gamblers, not for day traders, not for financial adrenaline addicts. And the advantage you gain by following this simple system will compound for decades. Here's what you should walk away with. Wealth is about peace, not prediction. Simplicity beats complexity every decade. ETF investing gives you clarity in a chaotic world. A simple plan creates emotional freedom. Your future is shaped by consistency, not cleverness. Munger's wisdom is your lifelong guide. We've gone through the entire journey. Now all that's left is the final step, your call to action and the beggie. We've spent nearly 30 minutes together breaking down everything that truly matters in long-term wealth building. We've gone from the shocking truth to the foundation, to the structure, to advanced insights, to your step-by-step plan, to the bigger picture of why all this matters for your life. Now, before you click away, I want you to pause for just a moment and actually breathe. Because what you're feeling right now is not just understanding, it's clarity. And clarity is rare in the world of finance. If you made it all the way to this point, it means you're different. Most people quit these videos halfway. Most people don't want discipline. Most people don't want consistency. Most people don't want the truth. They want shortcuts. But you stayed. You showed up. You committed to learning how to build real wealth the right way. And because of that, I want this final section to give you a gentle push, not pressure, not hype, but an invitation to change the rest of your financial life starting today. Let's tie everything together and end strong. You already know this. The world is full of noise, and the algorithm loves to feed you fear, hype, and get-rich-quick nonsense. This channel is the exact opposite. Here, we focus on clear frameworks, proven strategies, real math, long-term thinking, wisdom from giants like Charlie Munger, and content that respects your intelligence. Subscribing doesn't just help the channel, it helps you build a long-term environment that keeps you grounded and focused. Every week, I publish videos that sharpen your mind, calm your emotions, and strengthen your financial decision-making. Videos designed to keep you on track when the world tries to pull you off track. If you want more content like this, if you want to stay focused on the long game, if you want your future self to thank you, hit that subscribe. Turn on all notifications. Not because YouTube wants you to, because future you will benefit from it. If this video gave you the clarity you've been looking for, the next one will take you even deeper. The next video in this series is the 7% Dividend Blueprint, how to build passive income for life. This video shows you how to create long-lasting retirement income, how dividend ETFs work, how much to invest to generate $500, $2,000 a month, how to avoid dividend traps, how Munger thought about dividend stability. If ETF investing is the engine, then dividend investing is the cash flow that supports your lifestyle in retirement. The link is right on your screen at the end of this video. Click it. Keep the momentum going. Comments don't just help the algorithm, they help you engage, reflect, and take action. So here's the question I want you to answer. What is the one money habit you want to fix starting today? Saving more, investing consistently, ignoring the noise, living below your means, automating everything, increasing your contributions, stopping emotional decisions? Tell me in the comments. I read every single one. And more importantly, your comment could help someone else who reads it and thinks, that's exactly what I needed to hear. Your story matters. Your voice adds to the momentum. Your commitment inspires others. Before we end, I want to leave you with something Charlie Munger said that I wish every American heard before they started investing. Spend less than you make, invest shrewdly, avoid toxic people and toxic activities, and try to keep learning all your life. That's it. That's the formula, and everything you learned in this video supports that philosophy with practical tools. Spend less than you make, automate your contributions, invest shrewdly, use low-cost ETFs. Avoid toxic activities, ignore financial noise, Keep learning, come back for more long-term, reality-based financial education. There is no magic secret. There is no shortcut. There is no perfect moment. There is only the work, the consistency, the discipline, and the patience to stay on the path long enough for compounding to reshape your future. ETF investing is not sexy. It's not dramatic. It's not trending, but it works. It's reliable. It's durable. And it's yours to use for the rest of your life. If you commit to this path, if you apply the strategy we covered, if you build your 3 ETF portfolio and stick with it for 10, 20, 30 years, you will experience something life-changing. Peace, peace with your money, peace with your retirement, peace with your decisions, peace with your future. And that is worth more than anything money can buy. Thank you for spending this time with me. Thank you for choosing wisdom over noise. Thank you for choosing clarity over chaos. Thank you for investing in yourself. Now it's time to take action. Subscribe, comment your money habit, click the next video on your screen, and start building your ETF portfolio today. Your future begins now.